Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the messy world of corporate finance and unearth the real story behind those official filings. Today we're dissecting Shorepower Technologies Inc. SID's latest filing an amendment to their annual report, which means they're going back to fix something. Stick around because it looks like there's a little bit of a story here to unpack. So this filing we're looking at is an amendment to their annual report. Think of it like a company filing its tax return and then realizing they missed a number, or maybe even accidentally put the wrong number in and have to send in a corrected version. That's exactly what's going on here. They had to go back and tweak some things. This is specifically amendment number 1. So they're just making one round of corrections. They say this is solely to correct the categories and corresponding amounts for cost of revenue, and also add some details on how they're adopting a new accounting standard called CCL. Now, Shorepower Technologies is in the business of electric vehicle charging infrastructure. They build and operate these charging stations mainly for heavy duty trucks and refrigerated trailers. They've got a network of these stations spread across the country. Their stock is traded on the smaller market called the OTCQB. This is important because it often means the company is smaller and potentially a bit riskier than those listed on major exchanges like the NYSE or NASDAQ. Let's jump into the meat of what they're reporting, which includes their financials. Looking at the statement of operations, we see their financials for 2024 and 2023. In 24, they reported a net loss of about $450,000. That's actually an improvement from 2023 when they had a net loss of over $632,000. So they are losing less money, which is a good sign, but they are still losing money. Their total revenue for 2024 was around $65,000. That might sound incredibly low for a company that describes itself as a major player in EV infrastructure. For comparison, in 2023, their revenue was only about $20,000. So yes, they've seen a big jump in revenue, about 20-25%, but from a very small base. Now let's talk about the corrected cost of revenue. In their original filing, they had some numbers here that they had to go back and fix. For 2024, cost of revenue is listed as a negative $12,597, but it seems like this might be a typo within the context of the filing itself, as cost of revenue should typically be a positive expense. However, the critical part here is the gross margin. For 2024 though, Shorepower had revenue of almost $65,000. They actually had a negative gross margin of over $12,000. That means the cost of actually providing their services and products was more than the money they brought in from selling them. This is a classic red flag for a business. It's like selling a product for less than it costs you. To make it the poor part here is the gross margin. For 2024 though, Shorepower had revenue of almost $65,000. They actually had a negative gross margin of over $12,000. That means the cost of actually providing their services and products was more than the money they brought in from selling them. Their general and administrative expenses for 2024 were nearly $100,000. This is actually down significantly from 2023, where it was over $335,000. They mentioned this decrease happened because in the previous year they issued a lot of stock for services. Officer compensation jumped quite a bit in 2024 to over $186,000 from $120,000 in 2023. They note that this compensation wasn't actually paid and was deferred, which is common when a company is struggling with cash flow. This means the CEO and other officers owed a lot of money. In fact, if you look at the balance sheet, you can see accrued officer compensation related party is a massive $306,000 in 2024. That's the money owed to the officers. This is a pretty significant amount when compared to their overall revenue and cash situation. And speaking of cash, Shorepower ended 2024 with a mere $18,000 in their bank account. That's down from over $80,000 at the end of 2023. This is a very tight cash position for any company, and especially for one looking to grow and expand. Running out of cash is a real danger. Now, importantly, this company's stock isn't listed on any major stock exchange. This means it's traded over the counter and is subject to stricter rules and generally less liquidity, meaning it's harder to buy and sell shares. They also filed this as a smaller reporting company, meaning they don't have to provide as much detailed information as larger companies. They also talk about cybersecurity here. They say they have a program to manage cyber threats, and that so far these threats have not materially affected them, but it's something they continue to monitor. The auditor flagged revenue recognition as a critical audit matter. This means it's a complex area for them, and they had to put extra effort into understanding how Shorepower recognizes its revenue. They confirmed Shorepower is following accounting standards for revenue recognition. Let's look at the balance sheet. It really highlights the company's financial picture. Total assets for Shorepower at the end of 2024 were only about 65,000. That's a very small asset base. Compare that to their total liabilities, which were over 1.7 million. This means they owe way more than they own. They have a negative stockholders deficit, a bit like being in the red overall. Their accumulated deficit, which is the total net loss since the company started, is almost $3 million. This really shows they've never been consistently profitable. The audit explicitly states here that the financial statements have been prepared assuming the company will continue as a going concern. But then they add that the company's financials raise substantial doubt about their ability to continue as a going concern. This is the auditor's way of saying they're not sure if the company will be around in the near future. It's a very serious warning. The company has a bit of a history. It used to be called United States Basketball League Inc. and they changed their name and ticker symbol after a merger with Shorepower LLC. Jeff Kim is the CEO and has been involved in truck idle reduction for over 20 years. He seems to be the driving force behind the company's operations and strategy. There's also a mention of potential future stock issuances to Jeff Kim if certain performance milestones are met. These could be things like securing a certain amount of grant money or completing acquisitions. This is a common way to incentivize leadership in early stage companies. Looking at executive compensation, Jeff Kim's salary was over $186,000 in 2024, but as we saw, it was mostly deferred. He has a contract that ties his salary payments to the company's cash flow, which makes sense given their financial situation. In terms of ownership, as of April 2025, Jeff Kim personally owned over 26 million shares of common stock, which was about 55 of the company. He's clearly the largest shareholder and the key person driving the business. Now, for my take on all of this, Shorepower Technologies is a company in a growing market EVs and charging infrastructure. They have a real business concept to provide charging for trucks and trailers, and they've even secured some government grants, which is a smart move for a capital-intensive business. However, the financials are very concerning. They are burning through cash, making very little revenue and have a massive accumulated deficit. The auditor's going concern warning is a massive red flag that we cannot ignore. It means without more funding or a significant turnaround in revenue and profitability, this company might not be around for much longer. The fact that they had to amend their filing to correct cost of revenue also suggests that their accounting processes, especially for a smaller company, might need improvement. While Jeff Kim has experience in the field and is clearly dedicated, the business itself is currently not financially sustainable. It's a classic case of a company with a good idea and a potentially large market, but struggling to execute profitably in the short term. They need to drastically increase their revenue and manage their costs much more effectively or raise substantial new capital just to survive. What's your take on Shorepower Technologies? Do you think they can turn things around, or is this a company whose future is uncertain like the auditors suggest? Let me know your thoughts in the comments below. If you found value in this deep dive, don't forget to smash that like button and subscribe for more. We also have a fantastic community over on Discord, so join us there for more discussions. Thanks for watching and we'll see you in the next one.